Imagine stepping into a business that's already, making money, sidestepping all that startup chaos.
Right, bypassing the really risky part.
What if building wealth wasn't about gambling on a new idea, but, well, strategically buying something that's already working?
It's a fascinating concept.
Today, we're looking at exactly that, an alternative path. Wealth creation through buying existing businesses. We're drawing on insights from people like Jay Abraham and Roland Frazier.
Heavy hitters in this space.
You've brought your curiosity, your sources, wanting to get this quickly, efficiently. So let's unpack the core ideas. Building wealth by acquiring, not just starting. Welcome.
Yeah, it really turns the usual advice on its head, doesn't it? We always hear build it from scratch.
But the stats, they tell a different story. Startup failure rates are, well, sobering.
Pretty brutal.
Fewer than 1 in 3 make it past 10 years. Half are gone within 5.
And nearly 20% fail in the first year alone.
Incredible. So it makes you wonder, is there a less perilous way? And that's where this acquirepreneur idea comes in.
Exactly. And it's not saying one is better than the other. Founder versus acquirer.
Right. It's just different.
Different paths.
Yeah.
If you want to skip that intense, uncertain launch phase, acquisition is a really powerful option. You take over a dream that's already partly realized.
It's like joining a race, but someone else ran the really hard first leg. Yeah.
Yeah.
The proof of concept, the initial grind.
Yeah.
Done.
Someone else dealt with that.
And the key insight here isn't just buying any business, but targeting ones that are profitable, successful, but underperforming.
That's the sweet spot.
Okay, let's dig into that. What's the immediate win with that kind of acquisition?
Well, there are two immediate benefits, really. First, you get a business that's already generating cash. Profit from day one.
Okay, instant cash flow.
And second, this is the big one, there's usually huge potential to boost those profits through optimization.
How so?
Because often, the original owners, they're experts in their product, their service, but maybe not the overall business side of things. Marketing, systems, finance.
Ah, I see. So an acquirepreneur with broader business skills can spot those gaps.
Exactly. They can implement improvements the original owner might not have seen or known how to do.
Before we go further, for everyone joining us maybe through the Audiobook Quiver YouTube channel, welcome.
Great to have you with us.
If you're finding this interesting, maybe hit that like button for us. It really helps.
Yeah, absolutely. And consider following the channels for more reviews and summaries like this one.
Don't forget the notification bell, too, so you know when new content drops. Okay, back to it.
Right, so you've got the immediate profit plus the optimization potential.
So you're not just buying what it earns now, you're buying what it could earn. You're investing in potential.
Exactly. The existing profit is your base, and your skills are the accelerator.
But the sources say this initial profit, it's just the start. What's the bigger wealth play here?
The real wealth creation comes later. It's about becoming what Roland Frazier calls an epic acquirepreneur investor, understanding the landscape.
Epic. Okay, what does that entail? I know the C is important.
Right, the C stands for 3 major crises that are constantly creating these acquisition opportunities. If you understand these, you can spot deals.
Okay, crisis number 1.
Demographics.
Yeah.
The baby boomers are aging out, retiring.
Right. A whole generation of business owners.
Yeah, millions of them. They build these businesses now they want or need to exit. Health reasons or just wanting a change. It creates a steady stream of businesses hitting the market.
Makes total sense. Predictable wave. Okay, crisis number 2.
Market inefficiency. Simple supply and demand, really. There are way more small to medium businesses for sale than there are buyers.
How much more?
The sources suggest supply exceeds demand by maybe 400%. It's huge.
Wow. 400%. So basic economics,
Yeah.
that pushes prices down.
Favors the buyer. You got it. Gives buyers more leverage, better value.
Yeah.
And this isn't seen as a short-term thing either.
Okay, so retiring owners, inefficient market. What's the third C?
Business closures.
Yeah.
Millions close every year. And it's not always because they're losing money.
Really? Why else would a profitable business close?
All sorts of reasons. Owner retirement, like we said. Divorce. Sometimes assets need selling. Maybe the owner just lost interest. Burnt out, even if it's making money.
So these are profitable businesses just stopping hidden gems, potentially.
Exactly. Often overlooked targets. It's not always about turnarounds. Sometimes it's just taking over something solid.
Okay, so the opportunities are there. How do you position yourself to actually grab one? What's the first crucial step?
Mindset shift. That's step 1. You have to see yourself and present yourself as an investor who brings value beyond just cash.
Explain that. Because often we hear no money down, but this sounds different.
It is. No money out of pocket is the goal. But that doesn't mean no value contributed. Your skills, your knowledge, your strategic plan, that is capital, valuable capital.
Okay, so if I'm not putting cash in, what am I investing?
Think about what cash normally buys a business. Labor, right? Marketing expertise,
Yeah.
better systems, equipment. If you bring those things directly, your marketing know-how, your operational skills, your network, you're providing what the cash would have paid for. You're adding value from day one. That's your investment.
That reframes it completely. Your expertise is the down payment, in a sense. Okay, the sources mention a 5-step plan. Let's touch on the first two.
Step one, place yourself above the business.
Yeah.
Don't get sucked into working in it like an employee,
Yeah.
or even just on it like a manager,
Above it, meaning
meaning you're the owner, the investor, the strategist. Setting direction, overseeing things. This is key if you want to scale and acquire multiple businesses. You can't be tied to the day-to-day of just one.
got it. Big picture view. What's step 2?
This one's critical for personal protection. Never risk your credit or personal assets.
Protect yourself.
Absolutely. Use legal structures like SPV, special purpose vehicles. Keep the business liabilities separate from your personal finances. Roland Frazier apparently learned this the hard way through his father's experience. Don't make that mistake.
Sound advice. Protect the downside. Okay, so we've got the mindset, the structure, now finding the deals. Step 3, sourcing and analyzing.
Right. Step 3 is source and analyze deals you want to acquire. This starts with building deal flow, getting a consistent stream of potential opportunities coming your way.
And how do you make sure it's the right kind of flow, not just random stuff?
You define your criteria first. What are you interested in? What's your background, your experience? What are your superpowers, as Roland calls them? Where can you add unique value?
Like the example with Roland, dogs, and marketing.
Exactly. He loves dogs. He's great at marketing. So he looks for pet businesses where his marketing skills can make a real difference. You align your search with your strengths and passions. There's even a what to acquire worksheet mentioned online to help with this.
That sounds useful. Okay, so you know what you're looking for. How do you figure out what it's worth? Valuation.
A common way is using a multiple of EBITDA, earnings before interest, taxes, depreciation, amortization. Basically, a multiple of annual profit.
And what kind of multiple are we talking?
It varies wildly by industry, size, etc., but the sources suggest aiming for something close to 1x EBITDA if you can find it. Generally, you don't want to go much over 5x, maybe unless it's a sauce business or something special. Again, there's an acquisition criteria worksheet resource mentioned for this.
Okay, aim low on the multiple. Makes sense. Leaves more room for upside. Now, the big question. Zero money out of pocket. How does that actually work? Give us the initial strategies.
Yeah, the magic, right.
Yeah.
Well, the sources break it down into 3 main types of initial zero money out of pocket plays.
Okay, type 1.
Advisory deals. You get paid for your expertise, advising a company. This gives you income, sure, but it also puts you inside, lets you see potential deals up close, generates deal flow.
Smart. Get paid to find deals. Type 2.
Equity partnership deals. You trade your skills or resources directly for a slice of the ownership. A word of caution here, though. Don't take on, like, huge operational responsibility just for a small stake. Maybe aim for under 50% ownership in these structures.
Okay, sweat equity, but be strategic about it. And type 3.
Self-funding acquisition deals. This is where the company you're buying essentially pays for itself through creative financing structures. We'll get into the specifics more later, but that's the core idea.
So leverage skills for advisory roles, trade skills for equity, or structure the deal so the business funds its own purchase. Very different from needing a pile of cash.
Totally different mindset.
Now, there was an interesting point about buying and selling multiple businesses versus just holding one long term.
Yeah, the power of the multiple. If you buy a business, improve it, and sell it for, say, 3x EBITDA, you realize that multiple, if you just hold it, you get the ongoing profit, which is good, but you don't realize the lump sum from the multiple gain.
So by doing it multiple times, acquiring, optimizing, selling, you potentially compound those multiple gains much faster than just holding one asset.
Exactly. You get to capture that valuation increase repeatedly. It can accelerate wealth creation dramatically compared to buy and hold forever.
Like compounding, but for business flipping, almost. Okay, interesting. Now, how do you even start thinking about what kind of business to acquire? There's this thing called the acquisition wheel.
Right, the acquisition wheel. It's basically a brainstorming tool. It helps you think about why you might acquire a business and what kind could fit your strategy, even if you don't own one yet.
So what kind of ideas does it spark?
Things like, Could you buy a competitor to grab market share? Could you buy a media company or website for lead generation? Acquire a company with products that complement yours to increase customer value.
Okay, so strategic bolt-ons.
Yeah, or vertical integration, buying suppliers, distributors,
Yeah.
even acquiring traffic sources like Facebook groups, email lists, SEO-ranked websites. It broadens your thinking beyond just buying another company, exactly like one you might hypothetically own.
Helps you see the synergy potential. Okay, so where do you find these potential deals, especially the ones not publicly listed, the off-market ones?
That's more about active searching. Networking is huge. Talk to everyone your contacts, people in industries you like, distributors, maybe even competitors. Financial planners, lawyers, accountants often know owners thinking of selling.
So shoe leather, basically.
Pretty much. Plus, using tools like LinkedIn Sales Navigator, ZoomInfo, Crunchbase to identify targets. Then it's about personalized outreach, not just generic spam. Building some rapport.
Makes sense. It's a relationship game, too. Once you find a potential target, what's the essential data you need first to see if it's even worth pursuing?
Due diligence starts early, even if it's lightweight at first. You need the basics. Revenue, profit, look at SDE, seller's discretionary earnings, which include under salary and perks, and also EBITDA. What's the owner actually taking out?
Okay, profit metrics. What else?
Assets, what equipment, vehicles, real estate comes with it. Liabilities, what debt, accounts payable are there, how much capacity are they using, could they handle more business, how do they get customers now they're marketing and sales? And, crucially, what does the owner want to do after the sale? Stick around, disappear.
Why is the owner's plan so important?
It affects the transition, knowledge transfer, maybe seller financing terms. You need to know their expectations. There's a target analysis data sheet mentioned that covers these points.
Got it. So a snapshot of the whole operation. We talked EBITDA multiples. What about valuing based on sales or revenue?
Yes, sales multiples are another angle. Less common for smaller businesses sometimes, but useful. Key thing is, smaller, less marketable businesses usually trade at much lower multiples than big public companies.
So don't use Apple's multiple for a local bakery.
Exactly. The sources suggest maybe taking public company multiples and dividing by 4 as a very rough starting point for small private ones. Look at resources like Equidam or NYU Stern for general benchmarks, but take them with a grain of salt for tiny deals.
Okay, adjust expectations based on size and marketability. Now, with all this info coming in, how do you quickly sift through potential deals? Is there a quick screen?
The sources mention a sort of rough AQ score. Like a quick filter, you look at indicators. Is it listed with a broker? Maybe a negative, surprisingly, in their model. Why? Because off-market deals might offer better terms.
Interesting. What else?
Location match. Good. Seller financing available. Could be good or bad, depending on terms. Asking multiple lows is good. Operating margin high is good. Age of business older is often better, suggests stability. You sign points, get a feel for which ones warrant a deeper look.
A quick smell test, essentially. Okay, let's talk about the gap. You find a business, it costs, say, $1.4 million, you want to pay zero out of pocket. How do you bridge that $1.4 million gap?
Right, that's the core challenge. Seller financing is one big way. Get the seller to loan you part, maybe even most of the price. That immediately reduces the cash you need up front.
Okay, so the seller helps finance their own sale.
Exactly.
Oh.
Traditional loans, like SBA loans or bank financing, are options too, of course. But the real focus in these sources is on the more creative ways to cover that gap without touching your own bank account.
Which leads us to the 10 ways to acquire with zero money out of pocket. Give us a few more examples of these creative strategies.
Okay, so these can happen before closing or after. Pre-closing, besides seller financing, you have things like carve-outs. Maybe the business owns assets, you don't need equipment, a building. You negotiate to exclude those, lowering the price.
Trim the fat before buying. Smart.
Or supplier financing. Talk to their key suppliers. See if you can get better payment terms, maybe extend them way out. Frees up cash flow. Revenue-based financing is another. You agree to pay the seller a percentage of future revenue for a period.
Paying out of future earnings. Okay, what about post-closing?
After you own it, you could bring in equity partners who maybe bring cash or needed skills. You could arrange inventory consignment, only paying for inventory as it sells. Some people do quick flips, buy it, clean it up slightly, resell quickly.
And then get out.
Yeah. Or secure sponsorships, maybe for a specific project that helps fund the overall deal. Think outside the box. Acquihire, buying mostly for the team, even borrowing from individuals, maybe short-term loans from your network, like Roland's neighbor example.
That neighbor example.
Yeah.
It highlighted goodwill, right? paying a bit extra almost.
Exactly. It emphasized the long game. Building relationships and a reputation for being fair and reliable, even if it costs a little more upfront, can pay off massively down the road. Don't burn bridges just to squeeze the last penny out of one deal.
It's about building a reputation as a good person to deal with. That's capital too, in a way.
Huge capital, social capital.
Okay, this is powerful stuff. For listeners who are thinking, wow, I want to learn more, where should they go? What resources were mentioned?
There's Roland Fraser's network, the Epic Board Mastermind, workshops, the Epic Accelerator. That's at epicnetwork.com. But a great starting point is the SAFE 5-Day Business Acquisitions Challenge
Pre-challenge.
at businesswealthwithout.risk.com, Access. That same site, they say, has tons of resources, lists of funding strategies, like over 220 of them.
Wow, 220 funding strategies. Okay, tons to explore there. And this whole acquisition piece, it's really just part one, isn't it?
That's right. Acquisition gets you in the door. Part 2 is about growth, what the sources call the profit explosion formula. How to actually scale and maximize the value of what you just bought.
So first you acquire, then you amplify. A compelling model.
Definitely. Step into something working, then make it work even better. Exponentially better.
So now that you know there's this alternative path, one that avoids the startup gamble, what kind of existing business could you see yourself taking to the next level? Something to think about.
Yeah, it really shifts your perspective, doesn't it? From pure creation to optimization and strategic growth. It's an exciting possibility.
Well, if you found this useful and you want more like it, engaging reviews, summaries, please do like this content and definitely follow the Audiobook Quiver YouTube channel.
Yep, and hit that notification bell too. That way you won't miss out when we explore other fascinating ideas.
Thanks for joining us today as we explored building business wealth through acquisition. Until next time.